All right. My name is Brittany Dunn, and I'm a partner here at Eide Bailly in Fargo. And just a brief background on me, I've been here for about 10 years, and for most of those 10 years I've worked with clients primarily in the dealership world. And so I'm happy to be here and have the chance to talk to you all about tax reform and specifically what that means for you guys as dealers. Before we get into the details, I do have to throw up the disclaimer. You know, we'll be talking about information that's general in nature, and you want to make sure before you make any changes or make any moves that you check with your tax advisor as well to make sure that looks and works with your specific situation. But to start it off, basically what we're looking at is tax reform, and that is the largest tax act that we've had in the last 30 years. The last one was in 1986. So it's a big deal and a lot of changes out there. And there are a lot of changes that we could cover, but today in this hour I want to cover the business changes that I think will apply to you most and that you need to keep your eye on in 2018. Now the headliner has been the corporate tax rate cut. That's what you heard a lot about on the news. And that applies to C corporations. So when I say corporate, I mean C corporations. But there was also significant individual changes, as well as significant changes to flow-through entities, such as S corporations and partnerships, and as well as sole proprietorships. And those flow-through entities have their income taxed at the individual level, so those individual changes will affect those flow-through entities as well. There are a lot of unknowns, and when we talk through, I'll point some of those out and some things that we're waiting on guidance on. But right now what we have is what the legislature put out at the end of December, and we are waiting on the IRS to issue regulations, which we hope to see sometime hopefully in July. The legislature makes it all seem very simple and very broad, but putting it into action, and some of those details will come with the IRS regulation. We also have state tax considerations we want to keep in mind, and we'll talk about that towards the end. This is federal tax reform, but because a lot of the states start their tax calculation with federal taxable income, it affects the states, and the states have the ability to opt in or opt out of this tax reform. So first off, we got a polling question, and those are for you on the webinar. You'll need to answer to get your credit. How familiar are you with tax reform? We'll leave that open for a couple seconds here.
All right, Brittany, and it looks like you can't see those results, so I am going to go ahead and read those off for you. So it looks like 30% are very familiar, 48% sort of familiar, 15% not really, and 7% have no idea what tax reform is.
All right, so kind of across the board, we've got some different experiences. So hopefully we can get you all up a little bit on your tax reform knowledge today. We'll start out with the corporate and individual tax rate changes. Like I said, the big winner and what you hear about a lot is the corporate tax rate reduction, and that is the adjustment for the corporate tax rate down from 35% to 21%. It used to be kind of a tiered structure. Now it's just a flat 21% for tax years beginning after 12/31/17. For those of you that might have a fiscal year corporation, you'll have a blended rate for that year that straddles the 1/1/18. We also had some individual rate reform, not quite as large as the corporate rate reform, but there was a reduction in rates that across the board are about 3%. Some of the brackets got widened as well, but I think in general it's about a 3% reduction in rates for individuals. So all of you flow-through entities that have your income flowing through to an individual owner, this is the rate that they'll be paying on that income. Another big change to kind of the tax calculation is the repeal of alternative minimum tax. So alternative minimum tax is an alternate way to calculate tax that was put into place about 30 years ago as well, as a way to make sure that high income taxpayers paid at least a minimum level of tax. And what you hear people talk about most is federal income tax, but you also calculate your tax based on alternative minimum tax rules, which basically just takes away some deductions, and you pay the greater of those. 30 years ago, it should have only affected a handful of people, but the problem was they did not index that calculation to inflation, so each year it affected more and more people, and really became a thorn in taxpayers' side because it was affecting probably too many people. So for corporate income tax purposes, they have repealed it completely, so you only have one method of tax now. And for individuals, they changed the calculation drastically. It's probably not important to know exactly how it's calculated. It's just that there is an exemption amount that they increased to make this not affect quite so many people. So for 2017, if your income was between $200,000 and $600,000 as an individual, it was almost unavoidable to get out of AMT. You ended up in that range. You kind of probably had to pay AMT tax. But starting in 2018, because of the way they've changed the formula, unless you've got some significant capital gains or tax credits or some kind of extraordinary items, you're not going to run into AMT. So they haven't removed it completely, but it will be much less prevalent. I think this brings us to our next polling question. AMT exemption that we just talked about begins to phase out at 500,000 AGI or 1 million for joint filers. True or false? And we'll leave that open just a little bit so everyone gets their answers in if you're looking for CPE credit.
All right, and we've got 61% say true and 38 say false.
All right, so 61%, the majority of you got that right. That is true. Okay, so we've talked tax rates and tax calculation. We know the corporate tax rate structure was the big winner and the individuals got some relief with about 3%. So how are they going to even the gap? Because the legislature knew that if they didn't do a little bit more for individual taxpayers, we'd have everybody jumping into the corporate tax rate environment. So what they did was they used this new Section 199A to level the playing field. And it's also known as the 20% pass-through deduction. And this is going to be what applies to many of you on the webinar and in the room here. So what this is a 20% pass-through deduction for any business income, and this is done at the individual level. So for taxpayers who are picking up ordinary business income from their S corporation or partnership, they will get a deduction of 20% of that. So basically, they're only going to be taxed on 80% of it. This applies to, like I said, income from sole proprietors, S corporations, partnerships, Schedule E, which is rentals, and Schedule F, which is farmers. So anybody getting that trade or business income. It doesn't apply to wage income, but just trade or business income that's flowing through to the individual. It looks like it's going to apply to both active and passive taxpayers, which is a good deal. In the past, sometimes passive taxpayers, meaning taxpayers who are silent investors in businesses, don't always get the same advantages that active taxpayers do, but this looks like it's going to apply to both, so it doesn't matter if you're actively involved in your entity or not, you should get this 20% deduction. So what is the eligible income? I've said it's eligible trade or business income. So what does that mean? The IRS didn't tell us what eligible income is, or I should say the legislature. They told us what it's not. So that is what we have to go on. So right now they're saying qualified business income is income and expenses from qualified trader businesses, and that excludes specified service businesses, which are service businesses in the field of health, law, accounting, consulting, actuarial, financial services. So that makes sense. You know, it's kind of professionals, so doctors, lawyers, accountants, financial investment guys. But then they also threw in this last sentence that says any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its owners or employees. That's the one that's really vague that we need a lot of clarification on. So if you think about it and play devil's advocate, a service business where the main asset, the principal asset, is the reputation or skill of the employees or owners, you could get really broad and say that's just about any business. I don't think that's what the legislature intended, but we certainly hope that they clarify this a bit. So for dealerships, you've got your retail sales side and then you've got your service side. What we want to make sure is that that service side isn't in that last sentence, doesn't get kicked out because of that. Like I said, I don't think that's what they intended. You know, certainly the reputation or skill of your owners or employees is one of your assets, but is it the principal asset? You know, maybe you could argue that it's not. So again, we want to wait for some clarification on that. Now, there are restrictions to how much of this qualified business income deduction you can take, and we're going to get into that. But also, we want to mention there are a few more types of non-qualifying income. So qualifying income does exclude capital gains, dividends, interest income. So that's all investment type income, and that makes sense. I think because capital gains and qualified dividends are already getting a preferential rate, so that would make sense that they're not going to get this QBI deduction. But they also what's important to note, they haven't listed on the excluded income rental income. So rental income seems to be included and allowed to have this 20% deduction. And that's a little bit different than we've seen in the past because there's been some past regulations where rental income has kind of been included under the investment income umbrella and, you know, not been have gotten such good tax treatment. But the way it's written now, we think rental income is going to qualify for this. So that's good news, but again, hopefully this will be really clear when they put the regulations out. So what are the limits? So we know we've got to have qualified business income. And so once we know we have qualified business income, there is one more limit we'll have to pass. And that is that your qualified business income deduction, your 199A deduction, cannot exceed the greater of 50% of the W-2 wages in your trader business, or this alternate calculation of 25% of your wages plus 2.5% of your unadjusted basis in qualifying property. So 50% of your wages, you know, for dealerships out there, wage is a high expense, so it likely, you know, probably won't come into play. But when we have rental businesses that don't have wages, that's when the second calculation is going to come into play, where you'll be making sure that your QBI deduction isn't more than 25% of your wages plus 2.5% of your basis in your qualified property. So what's basis in qualified property? Qualified property is any tangible property that you have that you are depreciating, so your buildings, your equipment, and it would be anything that is currently being depreciated. So 2.5% of the cost basis of your fixed assets. One thing that's unclear, and that another thing we're waiting for clarification on, is how this will work when you have a tiered entity structure or multiple entities with a common paymaster. It's all easy to think about when you think you've got one business and two individual owners, but when you have one business that's maybe owned by another entity, we think that those W-2 wage attributes will just flow through, but again, that's what we need regulation for, to tell us exactly how that's going to work. Also, when you have a common paymaster where you maybe have one entity doing having all of the employees, what does that mean for the entity that doesn't have the employees, that is just compensating that common paymaster? that's to be determined as well. There is some special eligibility at lower income levels. So if your income is below $315,000 on a married filing joint return, then you are not restricted by that definition of qualified business income or the W-2 capital base ceiling. So basically, said another way, if your income is lower than $315,000, you just automatically get the 20% deduction on your ordinary business income flowing through from your pass-through. But if it's over $315,000, that's when you've got to look at, do you have qualified income, and do you meet this W-2 capital base limitation? I'd be amiss if I didn't talk a little bit about reasonable compensation, because I think this topic is going to come up a lot now, even more than it has in the past. So an S corporation is required to pay reasonable compensation to their shareholders for the services that they provide. It's you have an S corporation with an individual shareholder, it's to that shareholder's benefit to limit that amount of compensation, because that amount is subjected to payroll taxes. So there are rules out there that require you to pay reasonable compensation, and the IRS does look at that. But now there's even more tax advantage to paying a low wage, because since wages don't get this 20% qualified business deduction, that will be another reason that you're not going to want to pay yourself much of a wage. So you can bet that the IRS is going to be keeping their eye on this, just as they have been, but maybe even more. Now, partnerships aren't required to pay their partners like a reasonable wage. They are paid through guaranteed payments, and that isn't even an area where there's much guidance. So it's yet to be seen what the IRS might do with that. And also, when you have a sole proprietor or a farmer, they don't even pay themselves any sort of wage, and they're not required to. They just report their income on their individual return. And so it's unclear whether the IRS is going to assert some portion of their income to be a reasonable wage or not. We really don't know, but that's just something that's come up in conversation. So a lot of questions. Just to recap, we need some clarification on the definition of qualified business income. We need some clarification on whether, what type of services are going to taint that qualified business income. What if you have an entity that has both service income, which could potentially be bad income, and an entity, that same entity has good income for retail sales? What does that mean? So a lot of questions there that we need clarification on. Now, if we get this clarification and we find out that, let's, for example, say service income taints the whole lot of income and makes it all bad income and not, you aren't allowed to have the 20% deduction, then we're going to have some planning opportunities around that. Probably need to restructure, make entities, with good income and bad income. But I don't think we need to do that yet. I think you should wait until we get some more clarification before you go that direction. All right, on to the next polling question. So the following is considered non-qualifying income under Section 199A, and then wouldn't qualify for the 20% QBI deduction. Capital gains, commodity, non-hedging currency, annuity income, or all of the above.
All right, and it looks like 78% got it correct with all of the above.
All right, great. That's right. Investment income in the nature of capital gains, interest income, basically investment type income that's not ordinary business income is going to be excluded from this 20% deduction.
Brittany, I am going to interrupt you really quick. I need to change the presenter quick. We're stuck on the polling slide, so I'm going to change the presenter back to you really quick. If you want to just hit that share my screen button. Perfect.
All right. Okay, so a couple of examples that we'll go through on this 20% deduction to maybe help you understand how this is going to work a little bit and what the dollars might mean. So the basic example, we've got Steve, who's a married business owner whose business income is $100,000 and his taxable income is $150,000. When they say business income, they mean income from, a sole proprietor, rental, or a pass-through. So qualified business income, it's just as simple as $100,000 of qualified business income times 20%. So it's a $20,000 deduction, so a $20,000 deduction to the taxable income. And we don't have to worry about any of the other limitations, what kind of income it is, or whether they have enough wages because their taxable income is below $315, so we're good to go. So that's easy. So he's only going to pay tax on 80% of that business income. Now let's look at a taxable income limitation. One thing I didn't probably make clear is that your 20% deduction cannot be more than 20% of your overall taxable income. So in this example, we've got a taxpayer whose business income is $100,000, but his taxable income is $76,000. That's probably after his standard deduction or itemized deductions or maybe losses on other things, capital losses. So 20% of his taxable income is only $15,200. So since that's lower than that $20,000 number, that your QBI deduction would be limited to the $15,200. Here's a wage limitation example. So let's say you've got business income of $200,000 and taxable income of $750,000. So we've got more than $315,000 of taxable income, so we need to look at if we have good income and if we have enough wages to support a QBI deduction. So we take the greater of the 50% of the wages, or our alternate 25%, 2.5% test, and we see that the $25,000, which is 50% of wages, is greater, and that will become our limit on our QBI deduction. So we don't get a full 20% of our qualified business income because our 50% of wages is less than that number. We think that when you have a pass-through entity, those wages, so if you own 50% of a business and the total wages of that business are $200,000, you own 50% of it, basically your share of the wages is $100,000. That's what you would use to do this QBI calculation. And then we'll take a look at just one more unadjusted basis of property example. So this is showing how that second alternate wage capital base limitation is going to come into play, likely with a rental property that doesn't have any wages. So Joy is a 33% owner in an LLC with rental properties. The business income's $300,000, no wage expense. That's typical of the rental business. But the unadjusted basis of the assets is $600,000. So that's like their cost basis in this building that they're renting out. So the step one is to determine Joy's allocable share of the income and wages and basis. So she owns a third of it, so she's got a third of the income, $100,000, 0 wages, and a third of the basis, which is $200,000. So when you calculate what 2.5% of the basis in the assets is, 2.5% of $200,000 is $5,000. That is going to be your QBI deduction because you are limited to the greater of the wage asset limitation or 20% of your QBI. So I think I see, from the dealership world, you probably have enough wages to support the QBI deduction because wage is a large expense for you, but if you have a separate entity for rentals or for your property that you're renting out, this might come into play there. So now we know we've got the 21% corporate rate. Now we've got this individual rate that's reduced, but we get to most likely for dealerships get this 20% QBI deduction. So it still begs the question, is the C corporation a preferred form of business, or are we okay in our flow-through entity structure? And I think it's a question I've heard a lot already, and it's one that every taxpayer should address. So if we look back, C corporations have fallen out of favor in the last 20 years. After 1986, S corporations and partnerships took off, and we see far more S corporations and partnerships, especially with closely held businesses like Minnie on the call here. The reason we see that is because of double taxation. C corporations are paying tax at the corporate rate, and then when they distribute cash to their shareholders are paying tax at the individual rate. They're paying a qualified dividend rate likely. So by the time you add those two layers of tax together, that's usually much more than the single layer of tax that a flow-through entity would pay. And it certainly was much more before we had this rate reform. Now our rates have decreased, so we need to relook at that. Now I'll be honest, we've run these numbers with a lot of businesses and we haven't seen really much that's going to indicate a great flow from flow-through entities to corporate form. This doesn't seem like it's going to make sense for most people. But there are some opportunities, I think, where it might make sense. So I would encourage everybody to meet with your tax advisor and look at the numbers and figure out just to make sure that you're in the right form. One of those reasons that you might want to look at a corporation in the future when you're creating a new entity is the Section 1202 gain exclusion. And I won't get into the details of that, but what it really is when you have C corporation stock and you're an original holder of that C corporation stock, when you sell that stock, you can exclude the gain on the sale of that stock as long as you are in a specified business and would qualify for it. So we don't see a lot of that now because C Corps have fallen out of favor so much, but going forward I think we might see more people starting C Corps if they feel like in their end game they can sell stock. That's the other part of it. You got to get someone to buy your stock, which isn't always easy to do. There's also a couple other C Corp taxes that come into play that make C Corps a little less user-friendly. There's a 20% personal holding company tax, and that's on investment income in a corporation, and also accumulated earnings tax, which is 20% tax on excess earnings that are in a corporation that aren't being distributed out to shareholders. So you can't just earn a bunch of money in a C corporation and hold on to it and not distribute it out to your shareholders to, not have to pay that dividend tax. So just one slide here to go through, when a C Corp is more favorable and when a pass-through is maybe more favorable. If you have NOL carry forwards, you're very profitable and you're expecting continuous growth and not going to be distributing out a bunch of cash, maybe that's when it makes sense to be a C corporation, and especially if you qualify for this gain exclusion. But if you have a sale in the near term or you have shareholders that are going to need cash out of this business, that's when you would want to, when it probably still makes sense to be a pass-through. And also if you qualify for the 199A deduction, then you certainly are getting a better effective rate. Because so the C Corps are getting a 21% rate, the pass-throughs are being taxed at the individual rate. The highest individual rate is 37%, but if you qualify for the QBI deduction, you're only getting taxed on 80% of your income. So that brings your effective rate down to about 30%. So now you're comparing 30% to 21% plus at a minimum 15% dividend rate. So the flow-through rate doesn't look so bad at that point. In the essence of time, I'm not going to go through 1202, but like I said, it's just a gain exclusion that you should certainly look into, and especially if you're thinking about starting a new entity. The other thing, when we talk about this potential conversion back to a C Corp or starting a C Corp, the corporate tax rate at 21% is a permanent rate, but it's only permanent as long as we have our current administration and Congress. They can call it permanent, but a new Congress could come in and make a new permanent rate. So there's that political risk. So I just think that before you make that change, you certainly want to run a lot of numbers and do a lot of research and consult with your tax advisor to make sure that's the right thing to do. And this, I think, is just a good slide that, the C Corp is kind of like a lobster pot, easy to get into, really hard to live in with the double taxation and really hard to get out of. So before you make any changes, like I said, just you want to make sure you're in it for the long haul. So we've got these rate cuts, which are great, and we've got this QBI deduction, which is great, but how we have to pay for this somehow. So let's talk a little bit about what deductions that they are going to take away to pay for this. There are many, but I am going to go through just a few that I think will affect the dealership world the most. Interest expense, excess business losses, net operating losses, entertainment expenses, those are all things that I think you'll have to address. So we'll start off with the business interest deduction limit. So this is a new limit on the deductibility of interest expense. And they're limiting the interest expense basically to 30% of your adjusted taxable income. And once your industry, the dealership industry, got a hold of that proposal, they lobbied hard to get their floor plan finance interest expense kicked out of the calculation because that's a large expense for you guys. And they were successful in doing that. So the formula ended up being that your interest expense could not be more than 30% of your adjusted taxable income plus your floor plan finance interest plus your business interest income. So basically what that does is any floor plan finance interest is excluded from this limitation. That's all good interest, and no matter what your income is, you'll be able to deduct that. It would just be any other interest expense that you might be limited on. Now, adjusted taxable income is not taxable income. It's actually like an EBITDA calculation, earnings before interest and depreciation. And we have a question here from Matthew. So Matthew asked what industries this would all apply to: auto dealerships, farm implement dealerships, and he asked if it would not apply to truck dealerships, or to construction dealerships, excuse me. So that really goes to the heart of what's the definition of floor plan financing interest. We're going to get to that in a couple slides, so just hang on a bit there. But I do think it's going to apply to construction as well, but there is some ambiguity out there on that. Yep.
Construction has the opportunity to the 100% bonus depreciation and not realize interest plan.
So Matthew just mentioned that the construction industry, if they didn't have to, if they were not included in this floor plan finance exclusion, would they be able to take bonus depreciation? So we're going to talk about bonus depreciation in a little bit, and we'll circle back to that question. Okay, so I think, it's important to know that the adjusted taxable income that they're basing this 30% limit on is EBITDA, earnings before interest expense, and depreciation for the next 3 years. 2018 through 2021, that's what adjusted taxable income is. After 2021, it's just taxable income before interest expense, and depreciation doesn't get added back in. So really for the next 3 years, if depreciation is a large expense for you, that number is going to be that number that you're basing the 30% calculation on is going to be a lot higher than your taxable income, and maybe won't affect as many people in the next 3 years. But after 2021, I think it might affect more people. So for your industry, auto dealerships, farm equipment, the deduction for interest for floor plan financing is safe the way it's written. Any excess interest expense that under this limitation gets disallowed is carried forward to future years. So it's not lost, it's just carried forward. So what is floor plan financing? The definition of floor plan financing is just as I have it up on the screen: indebtedness used to finance the acquisition of motor vehicles held for sale or lease and secured by the inventory. That's how it's written in the legislation. So what's a motor vehicle? They define that as a self-propelled vehicle for transporting persons or property on a public road, boat, farm machinery, and equipment. So the question is, and equipment, does that mean farm machinery and farm equipment, or farm machinery and any type of equipment? Construction equipment, that goes to that question there, whether construction equipment would be a motor vehicle. We haven't gotten any clarification on that. It seems like people in the industry think it does apply to construction equipment as well, but I guess that has to be clarified. Now, I've only talked to a couple people about that. So I think I certainly would wait for clarification on that, and hopefully we get that. Now, the other thing to keep in mind when we talk about business interest expense limitations is that these rules don't apply to businesses with less than 25 million of gross receipts. So if your business has less than 25 million of gross receipts, then you can kind of disregard this whole limit. Now, I think that if you have 5 businesses all with 20 million of gross receipts in them, and they're all owned by the same person, they're probably going to look at it on a control group basis. They didn't put that in the legislation, but most other tax rules are written that way, so I wouldn't expect anything different here. But again, we'll hopefully see some clarification on that. So, and as these disallowance calculations come in and we find we have disallowed interest expense, the treatment of that disallowed expense is that it's going to be carried forward to a future year. At the S corporation, it's going to be carried forward at the entity level. On a partnership, it's going to be carried forward at an individual level, individual partner level. So that's going to be kind of a little bit of a reporting nightmare, but that seems to be how they're going to carry it forward. Another thing they've limited is the business loss. Now, what they mean by this is that any excess business losses in excess of $500,000 on a joint return is going to be carried forward to a future year, starting in 2018. So I think this is easiest to understand by comparing the two rules. In 2017, if you had $1 million of wage income and a $750,000 loss coming through from your K-1, you would have $250,000 of taxable income, and that's what you'd pay tax on. Now in 2018, with the input of this new business loss limitation, that same situation would result in $500,000 of taxable income, because only $500,000 of Schedule K-1 income can be used to offset any other wage income or any other income, and the remaining $250,000 is carried forward to future years as a net operating loss. So that's how that's going to come into play. If you have multiple entities, we think that the way it's going to play out is you'll add up all of the income and losses from all of your K-1s, and that, as long as that amount's not more than $500,000, you know, that's the limit you're going to be looking at. So for S corporations and partnerships, this $500,000 is going to be at the individual level, and it's going to be after you take into account passive activity losses. So basically what this is going to do is allow you to only deduct $500,000 against your wage or other investment income, and any other would just be carried forward with your NOL. So that brings us to the other change for NOLs that they put into place. In the past, NOLs, when you have a loss on your individual return, you carried it back and then forward. Now, you're only going to be able to carry the NOL forward. So, except in a couple circumstances where you have disaster losses or farming losses. And you carry that loss forward, and it can only offset 80% of your future year's income each year. So if you have a NOL in 1 year in 2018, and let's call it $1 million NOL, and in 2019 you have $500,000 of income, you can only use that NOL to offset 80% of that $500,000. So there's no way to wipe it all out. Now you don't lose any of it; it's just carried forward to the next year. So they're just minimizing the amount of income you can offset each year to 80%. So now when we think back to that limit on only being able to take $500,000 of a loss each year, that excess of the $500,000 gets stuck in this NOL bucket and now becomes part of these 80% rules going forward. So what you really want to keep in mind there is when you're looking at planning, and you got to look at a couple years to make sure that you are getting the best answer over a couple of years, because if you have an NOL that you can't use 100% of in the following year, then you'll have to make the decision of whether you want, if there's any timing you can do, whether you can move any of that loss to the next year. And then last one I want to talk about is entertainment expenses, and I'm really surprised how much press and how many questions I've gotten on this one. A lot of people have questions on this. So meals and entertainment have always been 50% deductible, even if they have a business purpose. You take a client out to lunch or to a game, a sporting event, or a concert or something, that's 50% deductible. Meals haven't changed, but entertainment has. Entertainment is now 0% deductible. So any expenses incurred, even if they have the business purpose, are not deductible at the business level. They can be paid, but they're just non-deductible. So you probably want to take a look at your employee reimbursement policies and probably your policy in general with that entertainment. You know, there's non-tax reasons to do that sort of thing, but it might beg the question to take a look at your policy because you're not going to get a tax benefit for it. And also you might want to consider setting up separate accounts for meals and entertainment. Usually we see one account, meals and entertainment, and our tax preparer, they know that that's what's 50% deductible. Well, now we're going to be asking the question, what's your entertainment portion of it? So it's probably easiest to just have two accounts, so then you can easily segregate it out. All right, one more polling question. Which of the following deductions have been lost or limited? Interest expense, excess business losses, net operating losses, or all of the above?
Hey, Brittany, while we do this polling question really quick, we had a question come through the chat box, and I'm going to see if it's cut and dry enough to answer. So for 199A, does an item need to be depreciated in the current year to be able to use the 2.5% deduction? In other words, if an item is fully depreciated, you don't get 2.5% for that item in the 199A deduction computation?
Yep, I can answer that. So the definition of qualified, I forget the way they word it, the qualified asset is a depreciable asset. So it has to be being depreciated in that year to be part of that 2.5% calculation. But any tangible property has a minimum life for this calculation of 10 years. So even though you buy a fixed asset that maybe has a 5-year depreciable life for tax purposes and you take bonus depreciation on it or something, for the purposes of the 2.5% calculation, you would still get to put that cost, use that cost basis if you're in the first 10 years of that asset's life. So it doesn't actually have to be depreciated for an asset that has a less than 10-year life. Just has to be in the first 10 years of its life.
Perfect. And with that, polling results are in, and 91% say all of the above.
All right, so yes, that is correct. Interest expense, excess business losses, and NOLs all going to be limited, all deductions that are being taken away. All right, so on to better news. What expenses have they accelerated? And this is related to depreciation, so another big expense in the dealership world. We've had bonus depreciation at 50% for most of the last 10 or so years. There was a couple years we had 100%, but the new rule is 100% bonus depreciation on all qualified property starting on September 28th of 2017, actually. This was one of the few things that went into 2017. So if you buy property that has less than a 20-year depreciable life, you can take 100% of that deduction in year one. The other thing they did was change the definition of qualified property. It used to be just new property. You had to be the original user. Now it can be used property. So it's basically any property with less than a 20-year life. Now getting to Matthew's point here, when the dealership industry lobbied to get out of that interest expense deduction limitation, they got out of that. But on the flip side, they said, well then, okay, you don't get to take bonus depreciation on your property. So bonus depreciation is unavailable for any taxpayer who has deducted floor plan interest financing. It's the way it's written right now. There are quite a few questions about that though, and Matthew alluded to it. Is there the possibility that you could elect out of that floor plan interest exclusion? Maybe you don't need the exclusion. Maybe your floor plan interest, you don't have that much of it. Maybe your income is so high, you know, you're not going to run into those limits. So we don't know for sure is the answer. We hope that you can elect out of that exclusion and then get bonus depreciation, but we don't know for sure. And I think it's really too early to say one way or the other. Matthew's asking when we anticipate knowing the answer. We've been told and we are hearing that IRS is going to issue regulations in July. That would be, now whether they do or not is up to them, but that's when we're hoping to get some regulations to clarify this. So like I just mentioned, the unanswered questions are, can a dealership elect out, and does separating the taxpayer's activities into separate entities allow you to take bonus depreciation? So we're thinking that, so you have, let's say you have a rental partnership set up that owns your building, and then you've got your operating entity set up. That's a common structure. So you've got your building and maybe some equipment in there, but then you've got your operating entity that's buying some of the equipment. So it seems like the operating entity, that's the entity with the floor plan financing, interest expense. They might not get bonus depreciation, but the partnership that owns the building that doesn't actually have the floor plan interest financing, maybe they could get the bonus depreciation. So then your planning opportunity there is having the rental entity, you know, maybe buying some of those depreciable assets. We think at this point that could work, but you know, we've got a couple sentences in legislation that are basically saying a taxpayer that has property used in a trade or business with floor plan financing is excluded from taking bonus depreciation. I mean, that's what we have to go on. So we just really can't say for sure, but I think hopefully there's some planning opportunities around it if we can elect out of it, or maybe do some restructuring and get the assets in an entity that doesn't have floor plan financing. We can maybe still take advantage of the bonus depreciation. So that's bonus depreciation. The other opportunity to immediately expense depreciable assets is Section 179, and that's been in existence for quite some time. The only change to that, or well, there's a couple of changes. One of them is that they've increased the limits. In the past, in 2017, I think the limit was about $510,000 that you could take of 179, and the asset addition limit was $2 million. So you could, as long as you had less than $2 million of additions, you could take up to $510,000 of 179 and expense that in the first year, in the year of purchase. Now the limit is $1 million of 179 expense at the married filing joint level, with a $2.5 million asset cap, addition cap. After that, you're phased out. So if you can meet those requirements, even if you've got floor plan financing, you've got some opportunity to do some immediate expensing. The downside of Section 179 is that you cannot create a taxable income loss, a taxable loss with 179. You can only take your income down to zero, where bonus depreciation can take your income down below zero. And the other limitation on 179 is that when you have passive shareholders or passive partners that aren't involved, they've got some limitations at the individual level. So bonus depreciation is the easier way to go, but 179 you could get some benefit from too if you need to. The other thing they changed on 179 is what qualifying property is. Typically qualifying property for 179 is not real estate, it's tangible property, equipment, and maybe some kind of leasehold improvements or remodeling you did on the interior portion of a building. But certainly in the past, roofs, HVAC systems, fire protection, security systems, those haven't been eligible for 179, but now starting in 2018 they will be. So that kind of that really will be beneficial, because those assets would typically have a 39-year depreciable life, and when you can take 179 on them, getting it all in year one, that will make a big difference. One thing that that I'd like to mention, that when they made this legislation, they had intended to make a group of classification of property called qualified improvement property, and what that would be is the improvement to an interior portion of a building, as long as it wasn't structural, and they wanted to make that a 15-year life, so that would be eligible for bonus depreciation and Section 179. But in their haste, they did not write the legislation correctly and ended up leaving it at a 39-year life. So for now, qualified improvement property isn't going to qualify for accelerated depreciation until the technical corrections bill comes out, and we anticipate that this will be corrected in the technical corrections bill, but another item that we're still waiting on clarification for. And for you dealers that are working with farmers, if the farm property changes, thought I would throw it in there. Equipment used to be a 7-year asset for farmers, depreciated under 150% declining balance. They've made that a 5-year asset now under 200% declining balance, and what that really means is that they can depreciate it faster. So just for your farmers that are coming in, they can probably take advantage of bonus, Section 179, and they've got a quicker life even if they can't do bonus or 179 for some reason or don't want to do it for some reason. All right, I know we're running short on time, but a couple more things to mention. Accounting method changes. The cash method, you have 2 methods of accounting. There's accrual method and cash method. And typically people want to be on the cash method for tax purposes if they can be, because there's more ability to control your income. You had to be on accrual method if you had more than $5 million of gross receipts, unless you passed a few other tests. Now that limitation is $25 million of gross receipts. So it's going to allow more people to be on the cash method of accounting, which is likely preferable. So if you're in between 5 and 25 million, you'll want to take a look at if that's something you could take advantage of. Another change, like-kind exchanges got got some opportunities taken away from them. We see a lot of like-kind exchanges with real estate, and then also with you dealers when you have people trading in vehicles or equipment. Now like-kind exchanges can only be done on real estate. There's no ability to defer the gain on a vehicle or a piece of equipment that you're trading in. Sounds like a bad deal, but with bonus depreciation and the increased 179, it's probably a moot point. It probably isn't going to matter to those customers of yours, but that is a change that's out there. So maybe it's important to just remember that the change is out there, and if someone comes in, a customer comes in and maybe doesn't understand that it's not that big of a deal, or they're still going to be able to deduct the full amount, it's just an education piece for your salespeople. And last but not least, the Affordable Care Act is still in play. The only thing that changed with tax reform is that the individual mandate, the penalty for not having individual health insurance has been changed to 0 starting in 2019. So Affordable Care Act still in play, but if an individual doesn't have health insurance, they don't have to pay a penalty. That doesn't change the fact that all the rules about having to provide health insurance to employees, if you're a large employer, it just changes this one penalty on the individual side. And last in, first out inventory, LIFO inventory, a dealer's friend. Most people use it. That's always on the chopping block. We always get a lot of questions, especially around legislation time. And it was mentioned as a way to pay for this bill as well, but it did make it out of the legislation safe, and there's been no modifications there. So no changes to LIFO inventory. And the last thing we want to talk about is state income tax considerations. And like I mentioned, the tax reform is a federal tax reform, and the states are under no obligation to follow federal tax reform. But the reason it will indirectly impact the states is because most states start their taxable income calculation with federal taxable income, and then they add and subtract things from there. Depending on the state that you live in, and I know we've got people on the webinar that are across the country, some states are like North Dakota pretty much take whatever the federal government does and run with it and say we're good with it. Minnesota, on the other hand, has a completely different look at it, and they disallow quite a bit of the accelerated bonus depreciation in Section 179, and they already have proposals out there to make adjustments to Minnesota taxable income to remove some of the adjustments made by tax reform. So, we have to wait until all the states start making their rules. I think they are starting to now. I know there are proposals out in Minnesota. We're starting to see some guidance from the states about what they're thinking about doing, so we've got to keep our eye on that. I think the important thing to remember here is that you could be in a situation where your state taxable income is higher than your federal taxable income, and especially with the accelerated bonus depreciation and the QBI deduction, I think we'll see maybe more states that have adjustments than have in the past. We also heard at an individual level, there's some limits on the deductibility of state income tax and real estate taxes. So some states were getting fancy and creating charitable funds where you could donate to those charitable funds and get a credit on your state income taxes and essentially convert a state income tax deduction to a charitable deduction. But the IRS has already came out just in the last couple of weeks and said they're going to be looking at the substance of those over the form, and so that might not be as much of a slam dunk as the states had hoped for. So I think it's just a lot more to come on state income tax. So what do we need to do? In the last 5 minutes, here's some things I think you should take a look at and some action steps. So we talked about the decreases in tax rates and how they are going to apply to corporations and individuals. So we should take a look, you should take a look at your entity choice, review it, make sure it's the right entity choice, and model out what that means so you know you're in the right entity choice. We talked about the QBI deduction, the 20% qualified business income deduction. We'll have to keep our eye on the expanded definition of what is qualified business income, but you also want to take a look at what that 20% deduction means for you. You know, and because I think everybody, I would venture to guess everybody will be having a lower effective tax rate. So what exactly does that mean from a dollar standpoint? And what, as you're going through the quarterly estimates, the next of which is due just the end of next week, do those need to be adjusted because of the changes in rates and the 20% QBI deduction? Because it's not going, with the same income as 17 as 18, your tax bill should be less, I would hope. You do need to, you should also look at the asset expensing options that are out there, the bonus depreciation and the Section 179, and see where you can take advantage of that. A cost segregation study is something that a lot of people use to take their 39-year building property and convert it into shorter-lived property, and that's beneficial because it accelerates the depreciation. Now with 100% bonus depreciation for some taxpayers, or Section 179, it becomes even more attractive. So taking a look at what depreciation you can accelerate to create deductions now, but keeping in mind the, you know, probably the loss limitations that are also out there and the interest expense limitations. So that also brings us to interest expense. We've talked about that. I think it'd be a good idea for everybody to take a look at their interest expense. Now you've got dealers with floor plan financing that's excluded, but I think you want to be ready to monitor what more guidance will come out on that and whether you guys are going to get the ability to elect out of it. And if you are, you'll want to know if you should elect out of it. So take a look at your interest expense, see how it compares to your adjusted taxable income, and see how that's going to affect you. Accounting method, we want to take a look at whether cash basis makes sense for you, if that's even an option. And there are more accounting methods that you might want to take a look at changing within an hour of time. I couldn't go into them all, but talk to your tax advisor. There's some planning opportunities out there that you might be able to take advantage of. And then last but not least, monitoring the future guidance. States are going to be coming out with their rules, their adjustments. We hope the IRS comes out with some guidance soon in July. And then once we have that guidance, really looking at what that's going to mean for you and if there's any restructuring that can or should be done to take advantage of that. Like I mentioned, this is the largest tax legislation in 30 years. So this is, not just your run-of-the-mill tax law changes. This could be some big changes and I think some planning opportunities. So talk to your tax advisor and keep your ear to the ground about what's going on and what guidance is out there. I know we only have a couple minutes. I'd be happy to stay later and answer questions if we have them. I'm going to throw my contact information up here, my email address, my phone number. I'm also happy to take emails or phone calls if you have questions afterwards, or in the weeks to come. I'm happy to talk with you about those. So Tara, I'll let you see if there's any questions out there before we end the webinar.